Now let's talk about a rejection block. Okay, a rejection block is a candle. Okay, a wick. Okay, a rejection block is a wick. Okay, so
Yes.
something like this. Now let's talk about wicks. Okay, so now I'm gonna draw a bearish candle. Okay, I'm just gonna draw a bearish candle. Okay, yeah, that way you will understand it. Let's say we had this. Yeah, because it's the same thing, but yeah, in different forms. Okay, same thing in different forms. So let's see. Let me draw this out. Okay, so now let's say this right here is a bearish candle. Okay, this, let's say this right here is a bearish candle, and yeah, let's say the previous candle closed in here. Okay, let's say the previous bullish candle closed in here. Okay, so yeah, let me draw this out. Yeah, like this. So let's say the previous candle closed here. Yeah, so now where did the bearish candle open? Okay, where did the bearish candle open? From here, right? This is where the bearish candle opened. Okay, then as it opened, what happened now? Something like this. Okay, now I'm gonna draw the anatomy of this candle. Okay, so something like this. This opened.
Yeah.
Buyers started pushing it up. Can you see that?
Yes.
Buyers started pushing it up, and then sellers started pushing it down. Yeah, then they took over. That is why it closed as a bearish candle, right? That is why it closed as a bearish candle.
Oh,
So
yeah.
now what is an order block? An order block is the last push up before the push down, right? The
Yes.
last push up before the push down. So now in here, we're not going to look at the order block. We'll be looking at the rejection block. Can you see that? The wick.
Yes.
See? So the base of the wick. Okay, if the base of the wick is untouched, we can use that as a point of interest. Okay,
Yes.
we
It's
can
the
use that
highest.
as a point of interest. Okay, can you understand that? Okay,
Yes.
simple.
Yes.
Simple, but it's very important. Okay, very, very important, because we will be using breaker blocks a lot. Okay, we'll be using, I'm sorry, not breaker blocks, rejection blocks a lot. Okay, the wicks, the unmitigated, the base of the wick, we will be using that a lot. Okay, so I'll show you. Okay, I'll show you a lot of examples. So can you understand this? Like, you understand the logic behind it, right?
Yes. Yes.
I
I
hope
do.
it
I
is
do.
clear. Okay.
Yes.
Okay. So then, like, everything depends on where the liquidity is. Okay, so yeah, let's go to that. Then I'll tell you. Okay, now let's say right above this liquidity, we have a rejection block. Okay, then we're going to choose that. Let's say above that we have an order block. Then we're going to choose that. Let's say above that we have a breaker block. Same thing. Okay, we're going to use that, something like that. Okay, so everything depends on where the liquidity is. Okay, this is what's important. Okay, now what could happen is the market might retrace, and once it gets here, it might even give you a breakout structure on a lower time frame.
Oh, yes.
Right now, after getting this breakout structure, inducements. Okay, now what happens? After getting this breakout structure, more and more sellers are getting in, right? Now, more and more sellers are getting in. Now, what they will do is, okay, they'll think this right here was their confirmation entry. Now, they will be expecting a retracement back into that lower time frame point of interest, and then expansion to the downside, right?
Yes.
This is what they would expect. This is what they would expect. So now they'll be looking for maybe lower time frame blocks like this. Okay, now they'll try to sell it here with their stop loss above this high now, because why? That way they can increase the risk to reward, right? And then they will have the same targets. Yeah, this is what
sell more.
Yeah, they'll sell more. Okay, but now what happens is more and more sellers are getting in. Okay, and the best thing is the market might even respect these areas for a while. Why?
Yes.
More and more sellers, like they're inducing. Okay, they're making more and more people get into this trade. Okay,
Yes.
and then what happens is, yeah, once enough liquidity is built up, they will do this. They will quickly start buying it up.
Yes, they take it.
They'll quickly, yeah, they'll take out everyone. They will take out everyone.
Yes.
And also, now what happened was this right here was the lower high, right? If you're looking at market structure, the market was like this.
Yes.
This was the lower high. Now, if this happens, people will think this is a breakout structure.
Yes.
Right now, since price has gone above that high, now everyone will be confused. They will think, okay, now we have a bullish shift in market, right? They'll think we have a bullish breakout structure, but that is the inducement. Okay, that is the inducement. People are induced into believing that this right here was a breakout structure, but it's actually not. Okay, now you will understand this very clearly once we talk about trading ranges. Okay, because trading ranges will be very, very important. Okay, trading ranges will be very, very important. So once we talk about trading ranges, you will see that this right here wasn't even a valid structural point. Okay, this is what we call internal range liquidity. Okay, this is what we call internal range liquidity. And then, yeah, they buy it up, they take out everyone that wanted to sell here. Okay, and then remember, if they want to go lower, they will induce buyers into the market first. Okay, if they want to go lower, they're going to induce buyers into the market first. Because why would they do that? Because only if someone buys, they will have their stop loss below a low, right? Only if someone buys, they will have their stop loss below a low. So now what they're doing is they are inducing buyers into the market. So which means stop losses will get built up below these lows, and most importantly, below this low. Because why? Now people are expecting a retracement back into this area and an expansion to the upside. Right? Now, smart money traders, once again, they'll start looking at odd blocks in here. Supply and demand traders will start looking at demand zones in here. Okay, some people, let's say maybe Fibonacci traders might draw their Fibonacci's like this, call this the golden ratio, sweet spot and everything, and they will also buy it, stop loss below that. Okay, so now, yeah, like if you know ICT, he tells you liquidity is something like a magnet. Okay, liquidity is like a magnet and price is like a paperclip. What happens? It draws towards the magnet, right? This is what happens. This is what happens. So you will have to always know where this magnet is. Okay, where this magnet is, because that is where price is going towards. But remember, market structure is the most important thing. Okay, market structure will be the first one. Then comes liquidity. Okay, so structure combined with liquidity, because market structure is the one that's going to give you the direction. Okay, because if you understand the direction, the entries will be very, very easy. Okay, your entries will be very easy if you understand the direction, because that's the thing most of the people are struggling with. Okay, if the direction, if you understand the direction, your entries will be very easy. Okay, so now what happens is, this moves up, will take out everyone that wanted to sell here, including the ones that got their confirmation entries, and then they induce buyers into the market. Now see, buyers are induced into the market in the form of buy stops. Okay, buy stops are activated because since this was a swing high, breakout traders had their buy stops above that high, and then they will quickly push price back down like this. Okay, they'll quickly move down, and in these areas might give you reactions once again. Why? Because there are people who wanted to buy it here, right? They are induced. Now more and more buyers are getting in, and when enough when enough liquidity is built up, they will do this. Okay, then everyone gets stopped out. Okay,
everyone.
So, yeah, exactly. Now then smart money traders will tell you, oh, order blocks does not work anymore. Order blocks aren't working anymore. We tried to sell it here, even the confirmation entry got stopped out. We tried to buy it here, even the confirmation entry got stopped out.
It doesn't work.
Yeah, it doesn't work that way. Okay, it doesn't work that way. Okay, so we will be focusing more on this. Okay, the entry above the retail pool of liquidity. Okay, the entry above the retail pool of liquidity. So the safe place for the stop loss is above the strong high, but yeah, I know the stop loss is too much. Okay, I know stop loss is too much. The risk to reward is that
21.
We can have it above the point of interest. Okay, yeah, I don't use anything more than 5 pips or less than 2 pips. Okay, so the maximum would be 5 pips. Okay, so I'll show you. And then and the other thing is, like, we don't even have to go into the lower time frames. Okay, like I'll show you. Okay, we can get the 3 to 5 pip stop losses from the 1 hour time frame itself, sometimes even from the 4 hour time frame. Okay, so I'll show you. Okay, yeah, you don't have to go into the lower times, because that's the misconception. People think if you are a smart money trader, you have to deal more with the lower time frames, the 1 minute time frame. No, that's bullshit. Okay, that's not it. Okay, you can just get tight stop losses, like 3 to 5 pip stop losses from the 4 hour and the 1 hour itself. Okay, so I'll show you. And then you sell it here. This will be your target. This right here will be your target. Okay, because why? The market was still bearish, and this right here was only an inducement. Okay, this was only an inducement. Okay, so something like that. So, yeah, can you understand this scenario? I hope.
Yes, I do.
I do. Okay. And then same thing in a bullish market. Let's go through that quickly. Okay, let's say we had something like this. Okay, so let's say we had something like this. So we had a stop hunt, a breakout structure.
This is a strong low.
Yeah, that's a strong low. Okay, and then another break in here. Let's say we had something like this. Now we have this low. Okay, higher high, higher low, and a higher high, right? This is what we have. This is just basic market structure. Now, if someone wants to enter the market, like I told you, what will they expect? They will expect a higher low and a higher high, right? This is what anyone will expect. Okay, this is what majority of the traders would expect. So even smart money traders, now what will they do? They will look for an odd block or something in here. Okay, they'll wait until price gets here with their stop loss below this. They'll try to buy it. Okay, and same thing with the supply and demand traders. Might tell you that there's the demand zone. Okay, or it's a drop base and a rally and everything. But they will also do the same thing. Okay, but not only smart money and supply and demand traders, we have trend line traders that are expecting the same thing. Okay, expecting a retracement back into the trend line and an expansion to the upside. Okay, so now they buy it here, stop loss here. Okay, this is what they would do. And not only them, like I told you, we have break and retest. Okay, support and resistance. Okay, we have break and retest, support and resistance, and who else? Since this low right here is a swing low, we have breakout traders. Okay, we have the breakout traders that are having their sell stops below that low. Okay, so now in this bit of price action, where is the most amount of liquidity? Right below that low, right?
Yes.
Yeah, this right here is where the most amount of liquidity is. Okay, so we will not be looking for anything around here. We'll be looking for something below that. Okay, we will be looking for something below that. So this right here, once again, could be an order block, a breaker block, a rejection block, or else an imbalance. Okay, this could be anything. Yeah, but what makes it a high quality zone is the liquidity that is resting above that.
Yeah, okay.
Okay, this liquidity is what's going to make it a high quality zone. Okay, now what could happen is, yeah, the market might retrace, give you a breakout structure, then more and more buyers are getting in. Okay, might even respect that lower time frame point for a while, then another set of buyers are getting in, and then once enough liquidity is built up, what will they do? Okay, they will stop you out.
Yeah.
Okay, they'll start selling it so that everyone gets
can I
out.
ask you something?
Yeah.
What distance do you take for between the liquidity and your POI?
In here, that doesn't matter. Okay, that doesn't matter because yeah, just a tiny little wick below this liquidity is also enough. Like this. Okay, this is also more than enough. Okay, like because some people will tell you it has to be a 10 pip sweep, a 20 pip sweep. No, like for me, like just a tiny little wick below the liquidity is still a stop point.
Yes,
okay,
because sometimes there's many POI.
Yeah, there's many POI. So remember, we will be looking for the closest higher time frame point of interest.
The closest,
the closest higher time frame one. Okay, not just a random 1 minute order block in here. No, first we start from the higher time frames. And also when I say the higher time frames, it can be from the weekly, daily, and the 4 hour. Okay, then weekly, daily, 4 hour, 1 hour. And if there's nothing on those time frames, then since we have no other option, then we go into 30 minute and the 50 minute. But remember, the lower you go, the riskier the trade becomes. Okay, the riskier the trade becomes. Okay, so yeah, the best thing to do is look into the higher time frames. Okay, and then yeah, now this might pull down, take out everyone that wanted to buy here. Now sellers are induced into the market in the form of sell stops. See that? Now sell stops are activated. Okay, sell stops are activated, and then what they do is they will quickly move price up. Okay, up, and then now like I told you, some people would have thought that this right here was a breakout structure, right? Okay, some people might have thought this is a breakout structure. Now they might be looking for order blocks in here maybe to sell from, right? Okay, now what could happen is this might go here and break structure, then more and more sellers are getting in and then back. Okay, everyone gets stopped out. Okay, so we will be focusing on this entry right here. Okay, the entry below the retail liquidity. Okay, below the retail liquidity. Okay, so now remember, a high quality point of interest. Okay, a high quality point of interest will always have liquidity above it. Okay, we'll always have liquidity above it, and in this case below it. Okay, so remember that very well, above and below it. Okay, so this is what we call a high quality point of interest. Okay, so can you understand this? I hope it's clear.
Yes, I do.
Yeah.
So the